This binder is designed to confuse you. The glossy charts, the benchmark comparisons, the market commentary. It is all theater. It is designed to distract you from the only number that matters, the wealth transfer. That financial advisor you trust? The one who asked about your kids and bought you lunch? Statistically speaking, he's not managing your wealth. He is extracting it. The financial services industry is a wealth extraction machine. It operates on asymmetric information. They know the rules. You don't. They know that suitability is a legal loophole that lets them sell you trash. They know that fee-based is a code word for double-dipping. They know that keeping you terrified of the market is the only way to keep you paying their mortgage. Today, on Wealth Architect, we are going to audit the industry. I am going to give you the 5 nuclear questions that strip away the marketing. We are going to talk about reverse churning. We are going to talk about soft dollar arrangements. And I am going to show you exactly how to fire your salesman without ever having to speak to him on the phone. Again, this is not just a video. This is an emancipation proclamation for your money. Welcome back. I'm Ben. Here, we don't buy the pitch. We inspect the incentives. To understand the scam, you have to understand the players. Imagine you go to a butcher. You ask, "What should I eat for dinner to be healthy?" What will the butcher say? Meat. Is he lying? No, he sells meat. He believes in meat. But he is conflicted. He will never tell you to eat a salad because he doesn't sell lettuce. Now imagine you go to a dietitian. You pay her $100. You ask, "What should I eat?" She might say meat, or she might say salad. She doesn't care what you buy. She only cares about the outcome because you paid her for the advice, not the product. The financial reality. 90% of financial advisors are butchers. They work for broker-dealers, Merrill, Morgan, Edward Jones, etc. Their job is to move product. Mutual funds, insurance, annuities, stocks, the suitability standard, the legal loophole. Brokers operate under a law that says they must sell you products that are suitable. Suitable means it fits your age and risk profile. Best interest means it is the cheapest, best option available. Product A, an S&P 500 ETF. Cost 0.03%. Commission to advisor $0. Product B, a proprietary mutual fund. Cost 1.5%. Commission to advisor 5% upfront. Both are suitable. They are both stock funds. But product B makes the advisor rich and keeps you poor. Under the suitability standard, he can legally sell you product B and claim he did his job. We are looking for the dietitian. The fiduciary. The fiduciary is legally required to sell you product A. If they sell you product B, they can be sued. So, how do we spot the butcher in a dietitian suit? We ask question #1. Question number 1 seems simple, but there is a trap. The question: are you a fiduciary 100% of the time on every single account and transaction? The trap: the dual registrant, dually registered. This is the sneakiest trick in the book. Most advisors are registered as both a broker and an investment advisor. They have 2 hats. Scenario: you sit down. He puts on the fiduciary hat. He reviews your goals. He creates a plan. He charges you a fee for the plan. He is acting in your best interest. The switch. Then he says, "Okay, to implement this plan, we need to buy this variable annuity." The magic. In that split second, he takes off the fiduciary hat and puts on the broker hat. He is now a salesman. He sells you the annuity. He collects a $10,000 commission. He was a fiduciary sometimes, but not when it mattered, the transaction. The only acceptable answer: I am a fee-only fiduciary. I am never a broker. I do not sell products. I only give advice. I am a fiduciary 100% of the time. If they stutter, if they say, "It depends on the account type," run.now, we follow the money. The question: how exactly are you paid? Please list all sources of compensation, including 12B-1 fees, revenue sharing, and soft dollar arrangements. The trap, the 1% fee. Most advisors charge assets under management, usually 1%. You think 1% is cheap. Let's do the math. You have $1 million. You pay $10,000 a year. Over 30 years, assuming growth, that 1% fee will consume 25% to 30% of your total potential wealth. You are giving them 1/3 of your retirement just to pick funds. The reverse churning scam. In the old days, brokers churned accounts, traded too much to generate commissions. Now, they do reverse churning. They put you in a fee-based account, charging 1%, and then do nothing. They buy 5 index funds and sit on them for 10 years. Why pay 1%, $10,000 a year, for a buy and hold strategy you could do at Vanguard for free? If they aren't actively hedging, harvesting losses, or doing advanced planning... is theft. The hidden fees, 12B-1 fees. A. Marketing fee, buried in the mutual fund expense ratio, that gets kicked back to the advisor. Soft dollar arrangements. The mutual fund company doesn't pay the advisor cash. They pay for his office software, his trips, his conferences. It's a bribe disguised as business support. The architect's standard. We prefer flat fee or hourly advisors. I charge $3,000 a year to review your plan. This decouples their pay from your portfolio size. It eliminates the conflict. Now we check for handcuffs. The question: does your firm create its own investment products? And if so, what percentage of your clients are in those products? The white label scam. Many big banks create their own mutual funds. They are often mediocre funds with high fees. But the bank puts pressure on the advisors to sell them. They might even white label them, meaning they take a generic fund, slap the bank's logo on it, raise the fee by 0.5%, and sell it to you as exclusive. The captive agent. If you work with an insurance company advisor, they are captive. They cannot sell you a Vanguard index fund. They must sell you the insurance company's whole life policy or their expensive annuity. They are not shopping the market for you. They are a distribution channel for the mothership. The verdict: you want an independent RIA, registered investment advisor. Someone who uses a custodian like Charles Schwab or Fidelity, but is independent. They can buy anything. They have open architecture. This is the subtlest conflict of interest, and it destroys your wealth. The question: what is your stance on me paying off my mortgage or buying rental real estate? The AUM conflict. Let's say you have $500,000 in your investment account. You have a $200,000 mortgage at 7%. Mathematically, paying off that 7% guaranteed debt is a great move. What will the advisor say? Oh, don't pay off the mortgage. You get a tax deduction. Keep the money in the market where it can grow at 8%. Why do they say this? Is it math? No. If you take $200,000 out of the account to pay off the house, his fee drops. He loses 1% on that $200,000, $2,000 a year. He has a direct financial incentive to keep you in debt so he can manage your cash. The real estate bias. Same thing with rental properties. Real estate is illiquid. He can't charge 1% on a duplex. So he will tell you real estate is risky and a headache. He wants you in the paper casino because that is the only place he gets paid. The architect's standard. A true advisor looks at your net worth, not just your investable assets. If paying off the mortgage buys you peace of mind, A fiduciary says, do it, even if he makes less money. This is the question that ends the meeting. The question: can you log into your personal brokerage account right now and show me what you own? The doctors who smoke paradox. If your doctor smokes, do you listen to his advice on lung cancer? If your advisor is selling you a target date fund or a variable annuity, does he own it? Or does he own real estate, Bitcoin, and low-cost index funds? The excuse: they will say, compliance doesn't let me show you. False. They can redact the dollar amounts. They can show you the percentages and tickers. They will say, my situation is different. Translation: I know this product is garbage, so I don't buy it. But I need to sell it to you to hit my quota. The 1% do not eat dog food. If they aren't eating their own cooking, walk away. You want an advisor who invests alongside you. I am putting you in Fund X, and I have 20% of my own net worth in Fund X. That is skin in the game. So, you ask the questions. They failed. They are a commission-hungry, captive salesperson. Now comes the hard part. The breakup. Most people stay with bad advisors for years because they are afraid of the awkward phone call. Hey Bob, I'm firing you. Bob is a salesman. He will guilt trip you. He will scare you. You're making a mistake. The market is volatile. The ACATS. Secret: you do not need to call Bob. You never have to speak to him again. Protocol: open a new account at a discount broker. Fidelity, Schwab, or your new independent RIA. Fill out an ACATS. Transfer form: automated customer account transfer service. You give the new broker your old account number. The new broker pulls the money. It happens in the background. Bob will wake up one morning, see a transfer notice, and the money will be gone. By the time he calls you, the account is closed. You can send a polite email: I have decided to move in a different direction. The transfer has been initiated. Please do not contact me. Do not let politeness cost you your retirement. The financial industry relies on you feeling small. They use jargon to make you feel stupid. They use suits to make you feel inferior. They want you to believe that managing money is rocket science. It is not. It is 5th grade math wrapped in a terrifying narrative. If you can answer these 5 questions, you are more qualified than 90% of the population to vet your team. You are the CEO of your life. The advisor is an employee. If the employee is stealing from the register, you don't feel bad about firing them. You walk them out the door. Be the architect. Own the blueprint. Here is your homework. The audit challenge. I want you to send an email to your advisor today. Subject line: clarification on fiduciary status. Body: are you a fiduciary 100% of the time on all accounts? And do you receive any 12 billion to 1 fees or revenue sharing? Post their reply in the comments. We are going to decode them together. I will tell you if it's a generic compliance script or a real answer. And if you want to know where to put that money once you fire your advisor, how to build the sovereign portfolio, subscribe to the channel. Hit the bell. Class dismissed.